Allora, caro decano, carissimo professor Franzoni, cari colleghi, studenti, collaboratori, gentili signore e egregi signori. Sono molto lieto di dare avvio a questa serata dedicata alla ricerca in ambito finanziario e alla celebrazione ufficiale dell'inizio del cammino all'USI di uno dei nostri professori di recenti entrati in ruolo. Il professor Franzoni, per necessità di ordine scientifico, terrà il suo intervento in inglese. È per questo che ho deciso di fare un po' di arbitraggio, che entra in tema, e di riequilibrare la situazione portandovi il mio saluto in italiano. Dopo aver letto il titolo della lezione inaugurale di questa sera, è affiorata alla mia mente la figura dell'arbitro. Arbitrageurs o arbitragisti o arbitrageurs, non so come volete metterlo nelle varie lingue, deriva dalla stessa radice da cui derivano nelle lingue neolatine le parole che indicano il giudice sportivo. Ma poi mi sono chiesto cosa mai possono avere in comune una realtà come un hedge fund e un arbitro di una partita di calcio. Il primo, infatti, spesso veicola nei profani l'immagine di una realtà avida, tesa alla speculazione ad ogni costo, insomma lontana dalle dimensioni di giustizia e garanzia della correttezza legata al concetto di arbitro. Gli hedge fund sembrerebbero semmai suggerire l'idea dell'arbitrarietà, del potere di distorcere gli eventi a proprio piacimento e a proprio profitto, più che l'idea dell'arbitraggio. Quasi fossero quell'arbitro armato di revolver, figlio del famoso bandito Butch Cassidy, immaginato dalla penna di Osvaldo Soriano. Una fama sicuramente non del tutto giustificata, e sono sicuro che il professor Franzoni saprà spiegarci meglio quale ruolo effettivamente giocano gli hedge fund e gli altri investitori professionali nel mantenere in equilibrio il mercato azionario. Ma soprattutto ci parlerà di quali sono i loro limiti e dunque di come, a dispetto delle teorie classiche, la verifica sperimentale mostri che non sempre gli arbitragisti sono nella posizione di ristabilire l'equilibrio sui mercati e talvolta, anzi, possono addirittura essere essi stessi la causa della formazione di inefficienze. Ed è forse qui che nella mia mente hedge fund da una parte e arbitri di calcio e hockey dall'altra iniziano ad assomigliarsi, forse un po' di più. Nell'esperienza del limite, nell'esperienza della difficoltà di tenere in equilibrio una partita magari molto scorretta, piena di risse e di imprevedibili azioni irregolari. Non so se tutto questo darà a nomi come hedge fund o exchange traded funds, nel bene e nel male, un volto più umano. E non so se sia legittimo o necessario che questo succeda. In ogni caso non penso faccia male a ricordarci che l'economia non è un Vangelo inalterabile di leggi matematiche, ma una scienza sociale che ha a che fare con l'uomo, con l'irrazionalità, con la complessità di una realtà irriducibile a soli numeri e statistiche. In questo scenario complesso, lo sguardo attento e approfondito dello studioso, la sua capacità di fornire gli strumenti per comprendere e valutare come stiano davvero le cose, sono una risorsa preziosa in direzione di una finanza più innovativa ed efficiente che sappia uscire più forte ed equa dalle sfide del presente. Il mio augurio al professor Franzoni è dunque di mantenere sempre la curiosità e la volontà di fare chiarezza proprie al ricercatore. Parlo di augurio perché, come sapete, quella di questa sera è una lezione inaugurale, una tradizione che sta prendendo piede anche presso la nostra università. Prima di lasciare la parola al decano della Facoltà di Scienze Economiche, il professor François de Georges, lasciatemi dunque ricordare quale sia il senso di queste lezioni inaugurali giunte al loro quarto ciclo. Nell'antichità il concetto di inaugurare indicava l'atto di affidare qualcosa che inizia la compiacenza degli dei, consultati attraverso la lettura del volo degli uccelli, e questo per accompagnarlo verso un futuro di sperato successo. Le lezioni inaugurali, iniziativa positivamente avviata 3 anni fa per impulso della conferenza decani dell'Università della Svizzera Italiana, intendono essere un modo per celebrare ufficialmente l'inizio del cammino all'USI dei nuovi professori di ruolo, con l'augurio che possano inserirsi al meglio nella comunità e stringere legami scientifici e umani con i colleghi di tutte e quattro le facoltà e con la realtà del territorio. Caro professor Franzoni, caro Francesco, che dunque gli dei della ricerca scientifica possano esserti propizi questa sera e durante tutto il tuo percorso con noi. In bocca al lupo. Devo chiedere subito scusa perché non potrò restare fino alla fine della lezione del professor Franzoni, mi dispiace, perché devo partire assolutamente per Basilea, quindi ecco. Mi scusi.
Dear President, dear colleagues, dear friends, it is a great pleasure for me to introduce Professor Franzoni's inaugural lecture tonight. One of the longest standing and most important controversies in financial economics revolves around the concept of market efficiency. It's an idea that, simply stated, says that security prices in an efficient market should reflect fundamental value. It goes back to at least Milton Friedman back in the 50s and the Chicago School. And it's very important because depending on whether the efficient market hypothesis is true, you get very different consequences for very important financial decisions. For example, if the efficient market hypothesis holds, then investors should not be able to earn, on average, returns that beat the market. Moreover, companies will make the correct capital allocation decisions because they will use the correctly measured discount rate when they value their projects. By contrast, if the efficient market hypothesis is not true, investors may be able to beat the market, and there may be some misallocations of capital because some industries might be able to raise capital too cheaply, and they will overinvest. Other industries, by contrast, might be, at times at least, might face a too expensive cost of capital, and they might underinvest. Now, this topic came in the news very recently because last month the three economists who won the Nobel Prize all devoted in fact their careers to the topic of market efficiency, even though at least two of them are very different sides of the issue. And we'll have the pleasure of hosting one of them next summer as our keynote speaker during the European Financial Association conference that this university is organizing. Now, one reason why markets might not be efficient is that sometimes investors are irrational, and sometimes even in predictable, systematic ways, and there's work that's been done by people like Kahneman and Tversky that shows that. But that's not sufficient, because the sort of trump card of the efficient market hypothesis is to say, well, even if some investors are irrational, other smart investors will come in and bid for the undervalued securities and drive their price up. They'll make money, and in the process, they will correct the mispricings and make markets efficient. And that's the arbitrage notion, which is at the heart of the research of Francesco Franzoni. About 15 years ago, economists started to question the theoretical foundations of this arbitrage argument, suggesting that maybe in some situations arbitrage might be limited. Francesco belongs to a new generation of financial economists who have started to take these ideas to the data. His research makes ingenious use of newly available data to throw new light on these outstanding questions. And the broad message, which I think we can already infer from the title, is that indeed the concerns that were raised at a theoretical level 15 years ago may well be warranted. That is, arbitrage may not be as powerful a force as one might have suspected. Francesco Franzoni got his bachelor's and master's degrees at Bocconi and his PhD from MIT. He has taught at Pompeu Fabra, at Barcelona, and HEC Paris. And I have to confess that one of my proudest achievements at UDI has been to attract him to Lugano from Paris, where both of us used to teach. Besides being a brilliant scholar, he's also a terrific colleague. To give you an idea, he's the kind of colleague whom, if you send him a paper at 6 p.m. asking for comments, he'll write back with detailed feedback at 1 a.m. We're very fortunate to have him in Lugano. Francesco, the floor is yours.
Ok. Vorrei prendere questa occasione per fare alcuni ringraziamenti e li faccio in italiano, e siccome ho qualche difficoltà con l'italiano li ho scritti. Allora, grazie Presidente per avermi dato l'opportunità di presentare il mio lavoro di fronte a questo pubblico di colleghi, studenti e amici. Vorrei cogliere questa occasione per dire che la ricerca che presenterò oggi è anche il frutto delle ottime condizioni lavorative che ho trovato presso l'Università della Svizzera Italiana 7 anni fa, quando sono arrivato. Avendo lavorato in diverse istituzioni universitarie, posso testimoniare che l'USI garantisce un ambiente molto favorevole alla ricerca. Di questo vorrei ringraziare l'Università, rappresentata qui dal professor Martinoli, e la Facoltà di Economia rappresentata dal collega professor De Giorgi. Inoltre vorrei ringraziare tutti i colleghi della Facoltà e dell'Istituto di Finanza in particolare per il loro contributo nel rendere questa istituzione un posto intellettualmente stimolante e riconosciuto internazionalmente. Infine un ringraziamento va anche al personale amministrativo, che rende così agevole la quotidiana attività lavorativa, il che è fondamentale per potersi concentrare sulla ricerca e l'insegnamento. Okay, so now I will switch to English for my lecture. Okay, so Professor Martinoli and Professor De Giorgi have, to some extent, already introduced the topic I will talk about today. So let me give you, some more perspective of where I'm going. And the way I decided to introduce these topics is to start from this year's economic prizes in economics. So the Nobel Prizes have been awarded to 3 researchers in financial economics this year. These are Professor Jim Fama of Chicago, who is considered the father of the efficient market hypothesis about which François was talking, and Professor Robert Shiller from Yale University, who is one of the founding fathers of this field of finance and economics that's called behavioral finance and economics. Finally, there is Professor Lars Hansen, again of the University of Chicago, who is the author of sophisticated economic techniques that are used extensively in all fields of economics, not just in finance. The common field of study of these 3 researchers is asset pricing, which is also the field in which my work is placed. Just a few words to say why studying asset pricing is important. Well, asset prices are important for the choices that all of us make. Think, for example, as to the saving decisions of whether to put money, our savings in cash, bank deposits, bonds, stocks. Well, those choices depend on the prices of these assets. Think about the housing decisions that we all make in terms of buying or renting. Again, asset pricing, in this case, real estate assets matter. And finally, one day, when we retire, we will earn some pension, some income that also will depend on the behavior of asset prices, so of behavior of the prices of the assets in which our pensions are invested. So this is at the microeconomic level. At the macro level, so we also know that asset prices are important, and we can experience that from the current economic cycle that is going through what is defined as a credit crunch, so a situation in which banks are not lending enough to the real economy, and that is also the result of the fact that the banks' balance sheets are burdened with assets whose prices have declined, so the banks don't have enough capital to lend. So asset prices are an important object of study, I would say. Going back to the Nobel Prizes, it's been observed by commentators, for example, by Professor Andy Law of MIT, that giving the award to Fama and Shiller at the same time displays a certain flair for irony. And that's because the two scholars hold very different beliefs in terms of how financial market works. So let me tell you about that for some time. So Jim Fama has a strong belief that financial markets work well. So he believes that financial markets are efficient, and the prices correctly reflect all the available information. So he has summarized these beliefs in what is called the efficient market hypothesis. So this intuition for this theory is simple. So the markets are populated by rational and competitive investors that trade on all the available information. As a result of this trading activity, the prices adjust and incorporate the information. Eventually, as the show says, the price is right. This simple but powerful theory has far-reaching implications. So the fact that the prices are correct today implies that, quite surprising, the future prices cannot be predicted. Better, we should say that the best forecast of tomorrow's price is today's price. I cannot do better than that. As a result of this unpredictability of asset prices, well, it's been said by some commentators, for example, there's a quote here by Barton Malkiel, that expert portfolio managers can do no better in picking stocks than a monkey that throws darts at a Wall Street Journal page. And these beliefs had far-reaching implications in terms of the development of the asset management industry. So the development of passive investments, so index funds and ETFs that we have experienced in the last decades is really the result of the belief that it's hard to beat the market. So we cannot do better than these monkeys. On the other hand, there's a Nobel Prize to Bob Shiller. Bob Shiller instead believes that prices move too much. And the volatility in prices, so these movements cannot be justified by the fundamental information, by the earnings and the cash flows of the firms. So he has expressed this belief in terms of what he calls irrational exuberance, in the sense that prices are affected by investor sentiment. So the investor sentiment finally goes into the prices and determines the long-term swings of the prices. Sometimes investors are optimistic and the prices are above their fundamental level. Other times they are pessimistic and the prices are too low. As a result of this, you have that prices are affected by bubbles, which are quick run-up in prices above fundamental, and crashes, so these sudden drops. Also, this theory has had important implications. Well, one of the offsprings of these kind of ideas has been the birth of the field of behavioral finance that really postulates that in economics, the economic agents are irrational, so are affected by psychological biases which eventually, enter into asset prices. As a result of that, and this is the opposite of what Fama believes, asset prices can be predicted by investors that are not affected by these irrational biases, that is, by rational investors. And how do we predict asset pricing? Well, we compare the prices that we observe in the market to the fundamental value of the firm, which you can read from the earnings and the cash flows of the firm. And if the price is too high relative to the fundamental, you should expect the prices to go down in the future. If the price is too low relative to fundamental, you should expect a positive return in the future. And then, fortunately for the asset management industry, there is a sense in doing asset management. So there is a dimension in which we can actually beat the market in picking the right stocks and choosing the right timing in which to get in and out of the market. Just to give you a sense of how successful these theories, this Shiller theory can be, look at this series which depicts the behavior of the S&P 500, so an index of US equity, in the last decade. You see, the first edition of this book, Irrational Exuberance, came out right before the peak of the internet bubble, over there. Oops. Over here. So a few months after the first edition of the book, the market crashed. So Shiller was saying that the market was overvalued, and quite soon the market actually collapsed. And then he had a second edition slightly revised edition of the book. They came out when the market was again reaching high valuations, and after a few years, the market tanked again. So to some extent, this irrational exuberance was prophetic, and not just in the equity market, but also in the housing market. So this is an index of the valuation of real estate in the US. You see, Shiller again made statements about the overvaluation of houses, of real estate. You see, this is the real estate bubble. And soon after his claims of overvaluation, we have this collapse of the market, through which we are still, which is still affecting the economy nowadays. Okay, so this is a powerful, well, this seems to be successful in explaining the empirical evidence, but, behavioral finance has to overcome an important conceptual hurdle, I would say. And this conceptual hurdle is a theory that has been, proposed by one of my professors at MIT, Steve Ross, which he calls a theory of sharks. So the theory goes like this. Okay, there's irrational investors in the market, but these irrational investors are confronted with more sophisticated investors, which we call arbitrageurs. So arbitrageurs are like sharks. They are ruthless and very efficient. So think, for example, of hedge funds. Perhaps this image of our hedge funds as sharks is justifying beliefs like the belief that the president was putting forward, that these institutions are not very benign, I would say. So if sharks, arbitrageurs, see a profit opportunity, they go for it. And they take care of it. So they eliminate these errors in pricing in financial markets. And therefore, as a result, arbitrageurs, like sharks in the oceans, they cleanse financial market from inefficiencies. So within these theories, eventually, after sharks have done their job, there should be no longer errors in the prices. So any mispricing should be short-lived. And already from a conceptual theory, this seems to be like a very powerful argument. So why is that in spite of these sharks, we still observe prices that are affected by bubbles and crashes? So how is it possible? Well, that's where other more recent theories that Professor deviations was mentioning come in. So these are theories first put forward by Andrei Schleifer and Robert Vishny that postulate that arbitrageurs are limited in their actions. So they don't have all the firepower that they would like, especially in the time where it's most useful. So, and that's because arbitrageurs are constrained in their actions by the agency relationship in which they are vis-a-vis their investors, so their clients. For example, during a bubble, arbitrageurs, institutions in general, may feel obliged to ride a wave, so to buy the overpriced securities. That's just because it's easier to justify to their clients that they are buying when everybody else is buying. If you had to say, okay, I'm selling, it's a much tougher decision. I think a quote due to the former CEO of Citigroup can summarize this kind of idea, and the quote is, as long as the music is playing, you've got to get up and dance. So you cannot sit on the sideline. You have to get into the party, let's say. On the other hand, during a crash, so when valuations are low, you would expect these arbitrageurs, these institutions, to buy, but that's when they need the capital to do that. And if their clients are poor, well, they are not providing the capital to the arbitrageurs, to the institutions. So they don't have the firepower to correct the market when they should do that. So that's the theory of the limits of arbitrage. Just to give you a sense of how important this theory can be, well, just have a look at this extract, which comes from the motivation, again, for this year's Nobel Prizes. Well, the Nobel Committee is pointing out the importance to the fact that rational investors are facing various institutional limits, such as credit constraints, that prevent them from going against the market on a sufficiently large scale. Okay? And that's where, my research comes in. So this is the kind of themes that I research. So I look at institutional investors and the extent to which they can be characterized as limited arbitrageurs. So I studied the limits that prevent institutions from correcting inefficiencies, and at times, these constraints are the very source of the inefficiency. So I'll provide results in which institutions are actually inducing inefficiency in prices as opposed to correcting them. Okay, so let's go into the details of some work that I've done. Okay, so in the first paper that I'm presenting, I'm looking directly at hedge funds. So this is work with Isaac Ben David from Ohio State University and Arabi Moussawi, who is the Wharton School. This paper has been published in the Review of Financial Studies. Okay, so we look at hedge funds. So hedge funds, are the closest that you could think of in terms of an arbitrageur. So if you want to give an example, a textbook example of arbitrageur, that's the hedge fund. Why is that? Well, because they have extreme freedom of action. So they can trade across different asset classes, so they are not necessarily specialized. They can use leverage, so they can increase the amount of capital that they dedicate to their trades, and they can engage in short selling, so they can sell assets that they don't own, they can borrow these assets to sell them. So they can do all sorts of things that other investors, such as mutual funds, cannot do. However, on the other hand, hedge funds depend on outside financing. They are not completely unlimited. So as a result of the fact that their capital comes from outside, they are vulnerable to the fact that investors can withdraw their capital and to the fact that their creditors, so their brokers, can issue margin calls. That means that they can call back their loans. So what we do in this paper is to see whether during the 2007-2009 crisis, so the last financial crisis, hedge funds were capturing the unique opportunity of buying mispriced securities. So the financial crisis offers a unique laboratory because there were, arguably many mispriced securities, underpriced securities. And, if arbitrageurs were doing their job, they should have bought up these securities. So we asked the question of whether hedge funds were doing that during this financial crisis. So it's a simple question. And here is the answer. So you see, here are the holdings of US stocks by hedge funds in the years from 2004 to the end of 2009 as a fraction of market capitalization. So what you see is that in a period before the crisis, hedge funds were actually piling up in stocks. So they were buying stocks. But then, as the crisis started to unravel, then they were downloading, so they were unwinding their positions in stocks, their long positions in stocks, especially during two periods. One period that's been called the quant meltdown in the August of 2007, when they downloaded about 12% of their equity portfolio, and in a second period, which is around the collapse of Lehman Brothers, which we all remember, in which they massively downloaded their stock portfolio into the market, and this is a reduction of 30% of their holdings. So it seems that hedge funds were not operating as arbitrageurs in this market. And we do more in the paper. We try to understand why they were operating like that. So why did they decrease their holding of US stocks? And to understand the possible sources, it's useful to look at the balance sheet of these financial institutions. So on the asset side of the balance sheet, so you have the stock holdings. On the liability side, you have the capital of the institution, so the equity, which is the assets under management, so AUM there. And you have the debt, so the money they borrow. So we ask whether the change, to what extent the change in the assets, so the change in the stocks they were holding, can be explained by a change in the liability side, so a change in the capital and a change in the leverage. So to give you the short story, look, for example, at this graph. You see these are the flows into the in and out of the capital of the hedge fund sector. You see they were experiencing positive flows before the crisis, but then they were experiencing negative flows during the crisis. That means that their investors were withdrawing capital massively during the crisis. So the assets under management decreased. Then we also look at leverage, and overall we get this result. We get the result that financial constraints, so the constraints on their capital in the form of investor redemptions and in the form of leverage, can explain up to 78%, so a very large majority of the sell-offs of stocks. So to conclude, the message of this paper is that hedge funds, arbitrageurs, were not able to lean against the wind, so to operate as arbitrageurs, because they were suffering from financial constraints. So this is the typical case, the typical example of a limit to arbitrage. So there is, we think, convincing evidence of limits of arbitrage. Okay, similar question in a different paper. So we look again in this paper at hedge funds, and we ask the question of whether hedge funds provide liquidity to financial markets. So what is liquidity? What does it mean to provide liquidity to the markets? Well, liquidity is a nice property of any markets, not just financial markets, but also real estate markets or used car markets, for what matters. So liquidity is the property for which I can trade fast at a low cost. So I can trade at the price I wish to trade and the quantity that I wish to trade. So this is a necessary property of any market. And in the market, there are investors that demand liquidity. So these are investors that need to trade fast. So think of, for example, of somebody who is in the need of buying a house. So they have a portfolio of stocks, and they need the money for the house. So they just want to liquidate this portfolio of stock as quick as possible to pay for the house. So these are investors that demand liquidity. And then there is investors that provide liquidity. So there are investors that are just there in the market, they are patient, they are not in a hurry, and they are just there to provide liquidity to these counterparties. And these second investors, the liquidity providers, perform a beneficial function. They are an indispensable class of investors for financial markets, and as such, they should be rewarded. So, in a paper with my colleague in the Institute of Finance, Alberto Plazzi, we look at whether hedge funds are actually liquidity providers. And the presumption is that they should. Why is that? Well, because whenever prices are moving away from their true value, because there's not enough liquidity in the market, that's when arbitrageurs step in to correct the price. So textbooks, so theoretical arbitrageurs should step in to correct the price and bring it back to its fundamental value. So this is the job of a liquidity provider. So hedge funds are special kind of traders because they trade a lot. They trade very fast. So you might have heard recently of all this new sector that has developed that's called high-frequency traders. So really, to understand the way they behave, you want to look at the data that captures all their trades. The current data on hedge funds, including the data I used in the previous paper, was using, to some extent, low frequency, so quarterly frequency, monthly frequency. And we argue that this is not enough to capture this activity of liquidity provision, given how fast hedge fund trades. And we have the fortune of having a data set here at the university in which we observe all the trades of a subset of hedge funds. So out of these, actually not just hedge funds, but many different institutions. So out of these data sets, we are able, and with quite some amount of work, to which I want to give credit to my co-author, we are able to identify the transactions of hedge funds. So 6.5 million transactions of hedge funds. So how do we use these trades? So we use them to measure whether hedge funds are actually providing liquidity to the market. So we need to come up with a measure of liquidity provision. And intuition for this measure is simple. So if you are a liquidity provider, you can get a better price than the other traders in a given day. That's because you are patient and you can just spot the better price. So if we compute a measure of price impact in which you compare the price at which the hedge fund trades to the average price at which all other investors trade, and this is a buy trade, then the price impact for a liquidity provider should be negative. Vice versa if the trade is a sell trade, but then we renormalize it to get again a negative price impact whenever we want to measure liquidity provision. So what are the results? So focus on these red boxes. So what we find here is that before the crisis, so this measure of liquidity provision is negative, meaning that they are actually providing liquidity to financial markets. So they are doing what you would expect them to do, but that's before the crisis. Then once you go into the crisis, this measure switches to positive. So they are absorbing liquidity from the market. So hedge funds are behaving like these impatient investors as opposed to being the patient investors. Again, so this goes contrary to what the intuition is about what arbitrageurs should do. So why is that that hedge funds do not provide liquidity to financial markets? So we have an analysis in the paper where we are able to explain this behavior, again, in terms of the financial constraints of the hedge funds, in terms of the fact that hedge funds are leveraged, so hedge funds that have higher leverage are less able to provide liquidity, as well as the fact that, the investors in hedge funds withdraw their capital in bad times, as I showed to you in the previous paper. So the flows are negative for hedge funds in bad times. And this is also justified by the fact that the investors don't know much about what is in the portfolios of the hedge funds. There is a lot of secrecy. So the investors are kind of nervous, afraid that whenever things turn bad, that's because the portfolio is holding some toxic assets. So as soon as they can, they take the money out. Okay, so another paper. And the focus here is on another group of institutional investors, and again the focus is on liquidity. So these institutional investors are private equity funds. So I'm going to talk about the paper that I have with another colleague of the Institute of Finance, Eric Novak, and Ludovic Philippot, who is now at the Oxford Business School. So in this paper, we look at investments in private equity. So what is private equity? It's an asset class consisted of investments in private companies, so companies that are not listed on an exchange. So these investments are managed by specialized funds. And the common belief is that these funds have an advantage because they are subtracted, so they are not exposed to the short-termism of financial markets. So they have a long-term horizon. So they can actually, take their time to do the right investments. And private equity investments are part of many institutional portfolios. So pension funds, insurance companies, university endowments invest in private equity as a means to diversify their portfolios. So the questions that we ask in this paper is, what is the actual performance of these private equity investments? And this is not a non-trivial question because being these non-listed companies, you don't have returns to compute their performance from. And the other question that we ask is, this perceived diversification is actually true diversification that private equity provides. And again, a picture to summarize the results. So what we show in this paper, so we have data on the cash flows of private equity investments for a subset of these investments, and we compute returns from these cash flows. And then we sort the returns according to realizations of an aggregate factor, a realization of the market, if you want to think about it. So on the right, you have good markets. On the left, you have bad markets. So what you see is that private equity gives good returns, very high returns. So these are annual returns, very high returns in good markets, so which we call high liquidity period because we define them by measuring the liquidity in the market. And they provide very low or negative returns in periods in which the market is illiquid, so in low liquidity periods. So what's the result here? the result is private equity underperforms when other investments are also underperformed. So private equity is exposed to the liquidity risk of the market. In this sense, private equity doesn't provide a true diversification. Actually, when we compute the risk-adjusted performance of this type of investment, so we compute what is known in finance as the alpha of these investments, including an adjustment for the risk of liquidity, we show that the alpha is indistinguishable from zero. Okay, and again, in the paper we ask why this is the case, and we give an explanation that is again related to the financial constraints, so to the limits of arbitrage that these institutions are facing. So private equity funds use a high degree of leverage in their investments. So up to 90% of capital is raised in the form of debt to buy up private companies. And this leverage needs to be refinanced periodically, typically at a frequency of 3 years. And if the refinancing period comes at a time when the market is bad, when the market is illiquid, well, perhaps these funds do not find the capital to refinance the deals. And as a result, they are obliged to liquidate these investments, and they are liquidating these investments in a bad market. And that explains the low returns when the market is illiquid. So again, we think that this is evidence in favor of the hypothesis that there are limits to institutions in their ability of being arbitrageurs. Okay, so we go back to hedge funds. And here I present some research that shows that actually not only arbitrageurs do not correct mispricing, but they also the very source of the mispricing, so the error in the prices, the noise in the prices. So one motivation for this type of analysis can come from this quote. So here you have Jim Cramer, which you might have seen if you watch CNBC, is now a commentator of financial markets. He used to be a hedge fund manager. And let me read this quote. What he's saying is that if I were long and I would like to make things a little bit more rosy, I go in and take a bunch of stocks and make sure that they are higher. A hedge fund needs to do a lot to save itself. So Jim Cramer here is describing a practice that's called portfolio pumping. So what it means is that if you are holding some assets, some stocks, for example, and you are coming close to the time when you have to report performance to your investors, then what you could do is to actually buy more of these assets so that you can push the prices up and the reported performance to your investor improves. This is obviously an illegal practice. It's actually market manipulation. And there's been actually investigations by regulators all over the world, and some mutual funds were convicted because of this portfolio pumping. So what we do in this paper is to look at whether hedge funds engage in portfolio pumping. So we want to provide systematic evidence. So this is a paper with a similar set of co-authors. So there's Isaac Ben David and Rabi Moussaoui again, with Augustin Landier of the Toulouse School of Economics. And this paper is forthcoming in the next issue of the Journal of Finance. So we give an affirmative answer to this question of whether hedge funds engage in portfolio pumping. And we think that this makes sense given the incentives, again, the incentives in the agency relationship in which the hedge funds are with their investors. So hedge funds have to respond to their investors in terms of performance, so it makes sense for them to manipulate the performance. And think about the compensations of the hedge fund manager. Well, that depends on how much money they are managing, and depends also on the returns that they are able to generate. So generating better returns gives them higher salaries. And the temptation to manipulate, so the temptation to modify the prices of the assets in their portfolio is stronger at the time when they are closer to reporting. So because they report monthly, so you would expect this misbehavior to be closer to the end of the month. And that's what we show here. So here we look at the prices of the stocks that have a high concentration of hedge fund ownership. That's the red line. And we compare it to the prices of the stocks that have a low concentration of hedge fund ownership. That's the blue line. So this is the behavior of prices in the last day of the month. So this is intraday data. You see that towards the close of the day, the prices of the stocks that are mostly held by hedge funds, experience this run-up. So this is about 30 basis points, which is a lot on a daily basis. So you might think that hedge funds have some special information, so they are able to predict stocks for which the prices will increase. Well, this could be a story, but then look at what happens on the next day. On the next day, so this is the open of the first day of the next month, the prices of the stocks with a high hedge fund concentration actually drop, and they drop more than the prices of the stocks with low hedge fund concentration. That means that the run-up that we observed was most likely due to price pressure induced by hedge fund buying, and then when on the next day, when the hedge funds have achieved their goal of manipulating the performance, they just dump the stocks back onto on the market, and the prices go back to their initial level. So to summarize, the agency relationship between the institutions, in this case the hedge funds, and their clients, generates incentive to misbehave. So what you observe is not only do hedge funds abstain from correcting mispricing, as in the first papers that I showed to you, but they also add further noise to the price. Okay, this run-up in prices are not motivated by fundamental informations. This is just noise. And again, because this, as a result of a constrained behavior, this is a manifestation of what we call limits of arbitrage. Okay, let me conclude. What's the timing? I hope I'm in time. Yeah. So let me conclude with a recent paper on which I've been working, which looks at the different type of institutions, which are ETFs, so exchange-traded funds. So what are exchange-traded funds? So they are a special type of investment vehicle, which is very similar to index mutual funds in that they replicate the performance of an asset class, be it a sector, a commodity, bonds, so all sorts of asset classes that you can think of. Now you have ETFs that replicate the performance of this asset class. So you can just buy an ETF, and through an ETF you can invest in gold, you can invest in agricultural commodities, and so on. Different from the mutual funds with which we are all familiar, the ETFs, the name says that, they are traded on an exchange. So they are like stocks. They have their own price. They have a price, the price that can be different from the value of the securities that are in their portfolio. And this generates some arbitrage opportunities, as I will argue. But first of all, let me tell you why, we think it's worth spending time by studying ETFs. Well, they are becoming a very big asset class. So this is the growth in the number of ETFs that are listed in the US markets. So there's many of them. There's around 1,500 different ETFs, and even more once you look at worldwide. In terms of assets under management, they are managing 2 trillions. 1.5 trillions are just in the US. What is even more important, we think, is that ETFs are taking up a bigger and bigger size of the volume in equity markets. On some days, ETFs are involved in 40% of the transactions that are taking place in US equity markets. So they are very important, and they are used a lot. So let me tell you about, arbitrage of ETFs. So the trading that surrounds this type of instruments. As I said, ETFs have a price because they appear on an exchange, but this price will be close to the value of the securities in their portfolio, so they will stay close, but it can at times be different just because it's an independent security from the securities in the portfolios. They are different. Well, they're traded separately, but deep down, fundamentally, they are actually the same thing, the ETF and the portfolio in the ETF, and those securities in the ETF. So the price of the two should not be misaligned. And if it is misaligned, there is an arbitrage opportunity. In particular, if the ETF price is above the value of the securities in the portfolio, which we call NAV, net asset value, then the trade is to sell the ETF and buy the underlying security. Vice versa, if the ETF price is below the NAV, then you should buy the ETF and sell the underlying securities. Once the price converge, you have an arbitrage profit. And indeed, there is a lot of arbitrage taking place between the ETFs and the NAV. This is really the realm of hedge funds and high-frequency traders. So there's a lot of sharks in these markets. So there is a lot of volume of trading around ETFs because of this arbitrage. And the question that we ask in a paper, again with the same co-authors, is whether this trading generates shocks, so generates volatility, that is then propagated to the prices of the underlying security. So think of a shock that materializes in the ETF market. So I'm holding a large portfolio of ETFs. I need the money because I want to buy the house. So suddenly I liquidate the ETF portfolio. This creates a negative price impact. So the ETF price goes down with no fundamental reason. Remember, I just wanted to buy a house. So nothing has changed in the true value of the ETF. And the question is whether through the arbitrage between the ETF and the underlying security, this shock can be propagated in the underlying security. So whether there is a volatility that goes from the ETF to the underlying securities. That's the question we ask in the paper. In this case, I don't have a nice picture to show to you. I will just tell you what the result is. The result that we find is the stocks that have a higher degree of ETF ownership, so the stocks that have more ETFs present in their capitalization, also have a higher volatility, consistent with the type of hypothesis that we want to test. So the result seems to be that ETF increase the volatility of the stocks in their portfolios, and we are talking about stocks in the US equity markets. So this result has important implications in the real economy. On the one hand, we tend to think that financial innovation and this wave of innovation that concerns ETF is beneficial because it helps investors diversify their portfolios. Through ETFs, I can invest in markets that were out of reach for me before. For example, I can invest in agricultural commodities. On the other hand, there is an unintended consequence. And the consequence is that shocks that materialize in the ETF market are propagated to these other markets that were previously immune from this level of speculative trading, from this arbitrage trading. So speculative trading enters in the markets of commodities, for example. So this resonates with the type of volatility that we observed recently in all these commodity markets. And also it resonates with the impression that we have that these markets that apparently have nothing to do with one another, the market for wheat, corn, pork bellies, and so on, they seem to move all together. So people, some scholars have talked about the financialization of commodities, the fact that there is more and more speculative trading in these markets. And you can see that this has far-reaching implications in terms of the welfare of people who actually rely on the prices of these commodities as consumers or as producers. So there's countries whose economic cycles depend on the prices of commodities. Okay, so this concludes the papers that I wanted to talk to you about. So let me just wrap up, summarize where I think that the research in finance is going, at least as far as this research I'm doing is concerned. So the way I see the historical development is as follows. So there's been some decades, the golden age of finance in the 70s and in the 80s, when the working assumption was that financial markets were perfect. So there were rational investors and the markets were efficient. And then there were results, especially empirical results, that were showing some cracks in this picture. And the evidence is under everybody's eyes. So we have bubbles and we have crashes. Okay? And as a result of that, there's been a new wave of theoretical and empirical research that is identifying a role for institutions in determining asset prices, and in particular is studying the interplay between institutions and their clients in determining the limits that arbitrageurs have in correcting the mispricing, so in correcting these bubbles and crashes. So as a result of that, we are coming out with a new view of what the sharks should be in financial markets. So there's an identity crisis for the sharks.